Hey everyone, welcome back to Corporate Decoder, the place where we translate corporate jargon into plain English and where sometimes the numbers tell a story that is far more interesting than the company wants you to believe. Today we are diving deep into Park Hotels and Resorts Inc. latest 10K filing, and let me tell you, it is a dense one. Think of it like trying to find a needle in a haystack, but instead of a needle, it is a golden opportunity and the haystack is made of hotel rooms. Before we start, if you appreciate getting straight insights from corporate documents like this one, make sure you are subscribed. We also have a Discord community linked in the description below, where we break down these filings and much more. Alright, so Park Hotels and Resorts Incorporated, which trades under the ticker symbol. PK is a big player in the hotel real estate world. They own and manage a ton of hotels and resorts across the US, and honestly, some of them are pretty iconic places. Think of them as the landlords of a lot of fancy hotels. Their whole game is to own these properties and then have other companies manage them, a classic real estate investment trust or REIT strategy. Now their strategy is pretty clear. They want to be the best hotel REIT out there. They are really focusing on what they call their core portfolio. That is, their best hotels, the ones that bring in most of the money. They are also actively trying to sell off their non-core, hotels essentially shedding the properties that are not performing as well or don't fit their long-term vision. They think this will make the company stronger and help them grow. And they are not just sitting back, they are pouring money into their core hotels. They have completed over $220 million in projects recently, including pretty massive guest room renovations at some of their most famous hotels. For example, they are renovating key towers at the Hilton Hawaiian Village Waikiki Beach Resort and the Hilton Waikoloa Village. And get this, the Royal Palm South Beach. Miami Attribute Portfolio Resort is undergoing a huge $100 million renovation and is expected to reopen in June 2026. Sounds like they are serious about keeping their prime properties top notch. But owning hotels is expensive, and that brings us to their financial health. They have been working hard to keep their debt in check. They recently upped their credit lines and have about $1 billion available through their revolving credit facility and an additional $800 million from a new delayed draw term loan. This gives them a lot of breathing room. They are planning to use some of that new money to pay off about $1.4 billion in mortgage loans that are due in 2026. Smart move, they are also using proceeds from selling those non-core hotels to further reduce debt. So they are very focused on financial stability. Now let us look at the numbers, and that is where things get really interesting. As of the 31st of December 2025, their property and equipment net of accumulated depreciation is valued at $6.9 billion. That is a huge amount of real estate, but if you compare that to last year where it was $7.3 billion, you see a significant drop there. This reduction likely reflects the sale of some of those non-core hotels that they have been talking about. And here is the kicker. For the year ended the 31st of December 2025, they reported a net loss attributable to stockholders of $283 million. Now that is a big number. Flip over to 2024 and they reported a net income of $212 million. That is a massive swing from profitable to a significant loss in just 1 year. This is the kind of number that makes you want to dig deeper. One of the biggest reasons for that loss is right here, impairment and casualty loss. In 2025, they reported a staggering $318 million in impairment losses. This is primarily from those same non-core hotels they are selling off. Basically, the company is saying some of these hotels are worth a lot less than they thought. That is a direct hit to their bottom line. Their depreciation and amortization expense also went up from $257 million in 2024 to $336 million in 2025. That big jump is partly due to accelerated depreciation because of those major renovations they are doing on their core hotels. So while that spending on renovations is good for the long term, it hits their reported earnings in the short term. But here is where Warren Buffett style analysis comes in. Companies like this use a lot of metrics that are not standard accounting. They have something called hotel adjusted EBITDA. For 2025, this figure was $644 million. Last year, it was $683 million. So while their net income took a dive, their core hotel operations adjusted for certain items are still pretty solid and only slightly down. The core hotel adjusted EBITDA, which is their really key metric, came in at $586 million for 2025 compared to $603 million in 2024. This shows that despite the big losses on paper from selling off assets, their main business, the core hotels, is still generating good cash flow and is only seeing a modest dip. Now let us talk about the risks. And boy, are there risks. They are obviously worried about the economy. Elevated inflation and interest rates could hurt consumer spending on travel. A recession is a big concern. They also mentioned the possibility of another pandemic. Remember the COVID-19 impact on hotels. They are also concerned about cyber threats. Imagine all that customer data being compromised. That would be a PR nightmare and a huge financial headache. And then there are the risks tied to their hotel brands like Hilton. If Hilton's brand quality or reputation suffers, it directly impacts Park hotels. They specifically mention that while they have experienced cybersecurity incidents to date, none have had a material adverse effect on them. But they are all too aware that this could change in the future. They have insurance, but there is no guarantee it will cover all potential losses. Let us quickly look at their properties. As of the 20th of February 2026, they have 34 hotels with about 23,000 rooms. The majority are in that core portfolio. A huge chunk of rooms are in Florida and Hawaii, making them heavily reliant on those markets. The Hilton Hawaiian Village Waikiki Beach Resort alone has almost 2,900 rooms. That is a lot of eggs in one basket. Now back to the debt situation. As of the 31st of December 2025, their total debt is about $3.8 billion. That sounds like a lot, but remember they are a massive company. The good news is that about 95% of that debt is fixed rate, so they are somewhat protected from rising interest rates. They have no major debt maturities until late 2026. And as we mentioned, they are using that new credit facility and sales proceeds to manage upcoming payments. They also included their management's report on internal controls over financial reporting, and it seems like everything is in order there. Their auditors Ernst & Young LLP also gave them an unqualified opinion, so no major red flags on their accounting practices from the auditors. Looking at their cash flow, this is another area where the numbers tell a mixed story. For 2025, they generated $398 million in cash from operating activities. That is down from $429 million in 2024. The main reasons cited are higher cash paid for interest and a decrease in interest received. This is a typical consequence of higher interest rates and potentially using up some of that cash for those renovations and property sales. It is interesting to note that in 2025 they repurchased about 3.5 million shares of their own stock for $45 million. They have another $275 million authorized for stock buybacks. This signals management's confidence in the company's value and their desire to return capital to shareholders. So what is the verdict on Park Hotels and Resorts Incorporated? On one hand, they are making strategic moves, selling off underperforming assets and investing heavily in their prime properties. Their core business seems to be holding up well based on their adjusted EBITDA figures, even though their reported net income is taking a hit from those asset sales and impairment charges. They are also managing their debt responsibly and have plenty of liquidity. However, there are significant risks. The economic downturn is a major concern, as is their heavy reliance on specific markets like Florida and Hawaii. The impairment charges highlight that some of their assets may be worth less than ideal, and the sharp drop in net income is something to watch. The company is essentially betting big on its core hotels and its ability to navigate economic headwinds. If their renovations pay off and the economy holds steady, they could be in a very strong position. If not, then those risks could definitely bite hard. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.